learners, welcome to the course of BCOC 136, that is Income Tax Law and Practice. I am your course coordinator Dr. Madhulika P. Sarkar, Faculty, School of Management Studies, Indira Gandhi National Open University. In this session, we will learn the basic concept that will help you to understand the course. As you are aware that every year rules of income tax will be changed or there will be certain amendments in the rules, we have to follow the rules accordingly. Before going ahead, we should know what is tax. Tax is a part of our income which the government of India takes from us for providing us numerous facilities like water, drainage system, protection enemies, internal and external enemies, developing infrastructure. In simple word, tax is a source of revenue for the government. There are two types of taxes, direct tax and indirect taxes. Taxes are levied by government on the taxpayer. Direct tax is the tax which cannot be shifted to others. It is levied directly on the income of the person. Income tax is a direct tax. So, let us know the brief history of tax. In India, this tax was introduced for the first time in 1860 by Sir James Wilson in order to meet the losses sustained by government on account of military mutiny of 1857. In 1918, a new income tax was passed. Against it was replaced by another new act which was passed in 1922. This act remained in force up to the assessment year 61-62 with numerous amendments. In consultation with Ministry of Law, finally Income Tax Act 1961 was passed. The Income Tax Act 1961 has been brought into the force with 1st April 1962. Since 1962, several amendments of far-reaching nature have been made in the Income Tax Act by the Union Budget every year. So, in basic concept is divided into two groups. First group is component of income tax, second is important definition. So, in component of income tax consist Income Tax of Act 1961, Annual Finance Act, Income Tax Rule, Circulation and Notification, Legal Cases. Important definition consists assessee, person, income, assessment year, previous year, marginal rate and average rates. So, the income tax law in India consists the following components. Income Tax Act 1961. The act contained the major provision related to income tax in India. Income Tax Rules 1962, Central Board of Direct Taxes, that is known as CBDT also, is the body which looks after the administration of direct tax. The CBDT is empowered to make rule for carrying out the purpose of this act. Finance Act. Every year, Finance Minister of Government of India present the budget to the Parliament. Once the finance bill is approved by the Parliament and get the clearance from President of India, it becomes the Finance Act. Circulation and notification. Sometimes the provision of an act may need clarification and that clarification usually in the form of circulation and notification which has been issued by CBDT from time to time. It includes clarifying the doubts regarding the scope of meaning of the provisions. Judicial decisions, decision given by Supreme Courts. Any decision given by Supreme Court shall be applicable as a law till there is any chance in law by Parliament. Such decisions shall be binding in all the court, that is tribunal, income tax authority, assessee, etc. First and foremost thing is who are liable to pay tax. So, every person is liable to pay tax. Every person who is earning some money, it may bought through job, through business or income from various sources, he is liable to pay tax to the government. Now the question arises, who is person? Generally we use the word person and individual in a same way, but this is not in case of Income Tax Act. The following are all persons, individuals like me, you or anybody. So individual means a natural person or a human being who may be male, female, minor, child. For example, Amit, Rakesh, Nidhi, any person. Second is Hindu undivided family. Hindu undivided family means which consists of all person linearly descendants from a common ancestor, including their wives and unmarried daughters. Company. Company may be defined as an artificial person created by a law which with a perpetual succession, a common seal and shares carrying a limited liability. Next is a firm. Firm is also considered as a person. So firms means a partnership firm which is defined under the Partnership Act. An association of person, it is also considered as a person, means two or more persons joining for a common purpose, for a purpose of earning income. Local authority, an authority legally entitled or entrusted by the government with the management or control of a municipal or local fund. Such authority includes municipality, municipal corporation, district board, etc. Then every artificial judicial person includes a public corporation which is established under the special law. So the definition of person is defined in section 2 of subsection 31 of Income Tax Act, includes an individual, a Hindu undivided family, a company, a firm, association of person or body of individual, a local authority, and every artificial judicial person not falling within any of the category mentioned above. Then who is an assessee? So we can say that assessee is a person who is liable to pay any tax or any sum of amount payable or have any obligation to pay tax. The term assessee has been defined in section 2 subsection 7 of Income Tax Act. Assessee means a person by whom any tax or any other sum is payable under this act. The term is defined to include the following: every person in respect of whom proceeding have been started from the assessment year of his income, every person who is assessable in respect of income of any other person, every person to whom a refund of tax is due, every person who is deemed to be an assessee under this act, every person who is deemed to be assessee in default under any provision of this act. Next definition is a previous year. Previous year defined section 3 of Income Tax Act. It means the year in which income is earned is known as previous year, and the next year in which the income is taxable is known as the assessment year. Income tax is charged on the total income of the previous year at the rate prescribed by the relevant Finance Act of the assessment year. A previous year is a period of maximum 12 months which will certainly ended on 31st March every year prior to assessment year. Previous year is the year immediately preceding the assessment year. Previous year is also known as the financial year. For example, the period of previous year related to the assessment year 21-22 is from 1st April 20 to 31st March 21. Let us take one example to understand better how we determine the previous year. Suppose X set up business on July 1st, 2020. What is the previous year of his assessment year 21-22? For assessment year 21-22, the previous year will be 1st April 2020 to 31st March 2021. Here X starts his business July 2020. So we consider the previous year from July 1st 2020 to 31st March 2021 is his Mr. X previous year for the assessment year 2021. Let us take another example. Mr. X joins an Indian company on January 20, 2019. Prior to joining this company, Mr. X was not in employment anywhere, nor does he has any other source of earning. Determine previous year of Mr. X for the assessment year 2021 and 21-22. So, for 21 assessment year 2021, previous year was January 20, previous year January 2019 to March 2020. Here for assessment year 2021, we consider previous year from January 20 because Mr. X joined an Indian company in January 20. So, the previous year will be January 19 to March 20. And for the assessment year 21-22, the previous year will be April 20 to March 21. Next definition is assessment year. Assessment year is defined in section 2 subsection 9 of Income Tax Act. It means the period of 12 months commencing on the April 1st of each year and ending on March 31st. For example, current assessment year is 21-22, which commence on April 1st 21 and will end on March 31st March 22. It is the financial year in which the assessment take place and assessee is required to pay tax in the assessment year on the income that was earned by him in the previous year according to the rate of tax prescribed by the Annual Finance Act. For example, the current assessment year is 21-22 and assessee is required to pay tax in this assessment year on the income that was earned by him in the previous year 2021. Let us take one more example. Mr. X joined a limited company on 28 June 2020. Before this, he has never been in any other employment. He has no other source of income. Determine the assessment year of Mr. Rakesh for his income between the period from 28 June 2020 to 31st March 2021 and also determined his assessment year for his next financial year. For assessment year 21-22, his previous year was 28 June 2020 to 31st March 2021 because Mr. Rakesh joined the company on 28th June 2020. So, his previous year was June 2020 to March 21. For next assessment year means 2022-23, the previous year will be 1st April 21 to 31st March 2022. Now, there is a difference between previous year and assessment year. Previous year defined section 3 of Income Tax Act, whereas assessment year defined section 2 subsection 9 in Income Tax Act. Previous year means financial year immediately preceding the assessment year, whereas assessment year means the period of 12 months commencing on the first day of April every year and ending on 31st March of next year. Previous year may be less than 12 months in case of newly set up business or profession. Assessment year will always be for a period of 12 months. The year in which income is earned is known as previous year. The next year in which previous year's income become taxable is known as assessment year. Now, the concept of total income. What is total income? The term total income is quite important. It is total income that is put to tax. The term defined in section 2 subsection 45, which says total income means the total amount of income, profit and gains as referred to in section 5 and computed in manner laid down in the Act. First of all, we have to determine the residential status of the assessee, then we compute taxable income under various heads of income like salary, house property, or profit and gain of business and profession, capital gain and other sources. Then by allowing deduction in respect of expenses incurred by assessee in earning those incomes up to the extent permissible under the provision. Then net result of adding taxable income from various head of income is gross total income. Out of gross total income, make all the deduction allowed under section 80C to 80U in respect of various expenses like LIC premium, contribution to provident fund, medical expenses, etc. The net total income so remain after allowing all deduction in terms as total income, which will be relevant for computation of tax liability. It is also known as taxable income. Now, the next topic is agricultural income. Agriculture is said to be a primary occupation in India. It is usually only source of income for the larger rural population in India. The country as a whole is entirely dependent on agriculture for its basic food requirement. The government has to boost his sector by means of schemes, policy and exemption for agricultural. It may seem like the fact of exemption to income tax is all that we need to know when it comes to the taxation of agricultural income, but there is more to it. Let us take a look the provision of the law in this regard. Agricultural income is not taxed under the Income Tax Act 1961 because agriculture being a state subject, it is a state government alone which is competent to tax income therefrom. The exemption to this income is provided under section 10 subsection 1 of the Act. There are three types of agricultural income. First is any rent or revenue derived from the land which is situated in India or is used for agricultural purposes. Second is any income derived from such land by agricultural operation or any process by cultivation or receiver or rent in kind which render the procedure fit for the market or the sale of such product. Third is any income from a farmhouse. One important point we have to remember that capital gain arising from the transfer of urban agricultural land shall not be treated as agricultural income. There are some conditions which have to satisfy the income from India is treated as agricultural income. First and foremost is the land must be situated in India. If land is situated outside India, the income from such land will not treated as an agricultural income. Land must be used for agricultural purpose. It means tilting of land, watering it, sowing of seeds, planting and similar operation of the land must be carried out by the assessee. The receiver of income from the land must have an interest in land. The landlord or tenant of land has an interest in the land. If the person purchases a standing crop, after that cutting, selling it and makes a profit, such profit is not an agricultural income. The direct income from agriculture is treated as agricultural income, and indirect income from agriculture is not agricultural income. For example, salary of a farm manager or dividend from a company engaged in agricultural activity is not an agricultural income. There are three types of income. First is rent or revenue derived from land. Rent or revenue derived from land situated in India and used for agricultural purpose is agriculture income. Rent is received by one person from another for the grant of right to the other person to use land. It may be cash or it may be in kind. Income from agricultural operations. An income is agricultural when some agricultural operations are performed. Agricultural operation means cultivation of field, watering it, sowing of the seeds, planting and similar operation on the land. Product which grows wild on the land are of spontaneous growth, are not involving any human skill or skill upon land, are not product of agriculture. This income is not derived from agricultural income. Income from making the product fit for market. If there is no market of the product of the field and the cultivation or receiver or rent in kind of performer, any activity to make produce fit for market, any income from such activity is also agricultural income. Income from sale of produce. Income derived by cultivator or receiver, rent in kind from sale of produce raised or received by him is treated as agricultural income, even if he keeps a shop for sale of such produce. Income from farmhouse. The income from farmhouse is treated as agricultural income if following conditions are satisfied. The building is owned and occupied by cultivator or receiver of the rent or revenue of any such land. It is situated or in the immediate vicinity of the agricultural land. The building is by reason of his connection with the land used as dwelling house or a storehouse or any outhouse by cultivator or receiver of rent in kind. The land is situated in urban area and is either assessed to land revenue in India or subject to local tax assessed and collected by officers of the government. Income from sapling or seeding. The income derived from sapling or seeding grown in nursery shall be deemed to be agricultural income. There are some non-agricultural income which we cannot treat it as agriculture income. So, non-agricultural income are like income from market, income from stone quarries, income from mining royalty, income from land for storing agricultural produce, income from supply of water for irrigation purpose, income from self-grown grass, tree or bamboo, income from fishery, income from sale of earth for brick making, remuneration received as a manager on agricultural farm, dividend from company engaged in agriculture, income of buyer or ripe crop, income from dairy farming, poultry farming, etc. Let us take one example which are agricultural income and non-agricultural income. From the following statement information, compute net agricultural income for the assessment year 21-22. Lease rent received from land given to tenant for agriculture operation is 68,000. Sale of agricultural produce, landlord's share is 30,000. Payment of government tax on agricultural land is 6,000. Expenses on power, irrigation, cess, farm labor 15,000. Purchase of seed 2,000. Tractor hire charges 3,000. So, here the computation of net agriculture for the assessment year 21-22 are lease rent. It is an income because rent received from land given by the tenant for agriculture operation. So, this is an agricultural income, that is 68,000. Then sale of agricultural produce is 30,000. So, agriculture income is 98,000. in these agricultural income, we have to deduct the expenses. Tax on agricultural land, that is 6,000, power irrigation cess farm labor 15,000, seeds 2,000, tractor hire charges 3,000. So, total 26,000 we have to deduct from the agricultural income, that is from 98,000. So, net agricultural income is 72,000. So, this agricultural income is exempt from tax. Now, there are some partly agricultural income and non-agricultural income. Sometime there is a composite income which is partly agricultural and partly non-agricultural. For determining the non-agricultural income is chargeable to tax. The market value of any agricultural produce which has been raised by the assessee and which has been utilized as a raw material in such business shall be deducted. No further deduction shall be made in respect of cost of cultivation incurred by the assessee as cultivator. For example, profit of sugar factory which produce sugarcane from grown on their own farm as treated as partly agricultural income. Sugarcane is generally sold in market. Hence, in order to separate the agriculture income from the business income, the average market price of sugarcane during the relevant previous year shall be charged as an expenditure and no note will be taken of the expenses of cultivating the sugarcane. The income thus determined will be business income. Second is income from growing and manufacturing of tea. 60% of income derived from sale of grown and manufactured by the seller is deemed to be agriculture income and remaining 40% is taken as a business income. Thirdly, income from growing manufacturing of latex and seeds. 65% of total income derived from sale of latex or senex or block rubber manufactured or processed by the assessee will be treated as agricultural income and balance 35% as a non-agricultural income. Expenses related to new plant in place of dead plant shall be included in the cost. Any subsidy received from rubber board shall be subtracted from the cost of production. Next is income from growing and manufacturing of coffee. 75% of the income derived from sale of coffee grown and cured by the seller in India is deemed to be agricultural income and remaining 25% is taken as a business income. 60% of income derived from the sale of coffee grown, cured, roasted and grounded by the seller in India without mixing or other flavoring ingredients are deemed to be agricultural income and remaining 40% is taken as a business income. Let us take one illustration. Mr. Ratan has stated in rubber, tree and coffee, he derives income from them. He has also a nursery where he grows plant and sell. For previous year ending 31st March 2021, he furnishes the following particular of his source of income from the state and sale of plant. You are requested to compute the taxable income of assessment year 21-22. So, manufacture of rubber is 6 lakh, manufacture of coffee grown and cured 2,50,000, manufacture of tea is 6 lakh, sale of plant from nursery is 1 lakh. So, the computation of taxable income for the assessment year 21-22 is manufacture of rubber, 35% of income is treated as business income, because here the income is 6 lakh, 35% of 6 lakh is 2,10,000. Manufacture of coffee grown curd, 25% of income is treated as business income. Coffee grown is 2,50,000, 25% of coffee grown is taken as a business income, that is 62,500. Then manufacture of tea is 40% of income is treated as business income. So, here the manufacture of tea is 6 lakh. So, 40% of 6 lakh is 2,40,000. Sale of plant from nursery is exempt because it is an agricultural income. So, total of 2,10,000, 62,500 and 2,40,000 is 5,12,500 is taxable income of Mr. Ratan. So, it is a taxable income and it is charged by the it is charged tax. So, in this session we have learned basic concepts, some definition like assessment year, previous year, assessee. Then we have already learned about agriculture income. Thank you so much. So, dear student, in this session we have learned some basic concept, some definition and what is agricultural income, how it is charged in the hands of assessee. Thank you.